Hey everyone, welcome back. If you felt that crash on October 11th, the trigger came straight from Washington. What one piece of data sent the market into a panic? Stick around, we're breaking it down. The crash was directly ignited by the hotter-than-expected U.S. Consumer Price Index, CPI, inflation report released on October 10th. The data showed inflation remained stubbornly high, dashing hopes that the Federal Reserve was done hiking interest rates. Instantly, market expectations shifted. Traders now priced in a higher-for-longer interest rate scenario, meaning borrowing costs will stay elevated. This is terrible news for speculative, risk-on assets like cryptocurrency. Why? Because high rates make safe investments like treasury bonds more attractive, pulling massive amounts of capital out of the volatile crypto market. It was a classic macroeconomic punch to the gut. You know that sickening feeling of watching your portfolio dip into the red? Now imagine you're a trader using 10 times leverage. What happened next was a brutal, automated domino effect that amplified the crash. As prices began to plummet following the inflation news, it triggered a massive liquidation cascade. The crypto market was over-leveraged, meaning many traders had borrowed funds to amplify their bets. When Bitcoin broke below key support levels, it sparked a wave of margin calls. Exchanges were forced to automatically sell these traders' positions to cover their loans. This created a vicious, self-feeding cycle. Forced selling drove prices down further, which triggered more liquidations. In just 24 hours, over $700 million in leveraged long positions were wiped out. This wasn't just panic selling. It was the market's internal mechanics violently deleveraging in a fire sale. For all the chart watchers out there, you saw it happen in real time. A critical line in the sand was crossed, and that's when the real floodgates opened. Let me show you exactly what broke. Technically, the market was holding on to a crucial support zone around $60,000 to $61,000 for Bitcoin. This level had been tested and held multiple times, making it a psychological bedrock for the market. The bearish CPI news was the fundamental hammer that smashed through this floor. Once that support was decisively broken, it invalidated the bullish structure for many traders and algorithms. This triggered a flood of stop-loss orders and technical selling, accelerating the drop toward the next major support near $57,000. The breach of this key technical level turned cautious pessimism into full-blown capitulation, demonstrating how powerful chart psychology can be in a fragile market. And what about your altcoin bags? If you thought Bitcoin's drop was bad, you saw the absolute carnage in the altcoin market. Why do they always fall harder, and what does it mean for your portfolio? As always, when Bitcoin sneezes, altcoins catch pneumonia. The fear and selling pressure weren't contained to BTC. Major altcoins like Ethereum, Solana, and meme coins saw devastating losses, often dropping 10 to 15% more than Bitcoin. This is due to their lower liquidity and higher risk profile. In a panic, investors flee to safety, and the only relative safety in crypto is Bitcoin. They sell their altcoins first to either raise cash or move into BTC, causing an exaggerated crash. This massive altcoin bleed is a classic sign of extreme fear and a market-wide deleveraging event, reminding us that in a downturn, correlation soars and diversification often fails to protect you. If this breakdown helped you understand the chaos, do me a huge favor and hit that like button and subscribe. Let me know in the comments.